finance, a la shmup. How do you assess the cost of equity? All right, so people, remember, that's equity, that's your stock, that's the ownership of the company. We're trying to figure out how you assess the cost of it when you do stuff with it, okay? So your specific motors, you're like General Motors, but your product's way less vague. With your stock at $20 a share and 50 million shares outstanding, Wall Street is telling you when they're paying $20 a share for your stock that Specific Motors is worth a cool $1 billion. Got it? 20 times 50 there. You want to buy your dreaded, hated competitor, Alfa Romeo, for $200 million. Yep, the one started by the little rascal, that one. So you've gotten your board to agree to let you make this transaction, and you've gotten Alfa Romeo to agree to it as well. The only question now is how you pay for this transaction. That is, how you pay the $200 million. Is it in cash or is it in stock? All right, well, you could borrow the money, and if you do, the rate of interest you'll pay is 7% with terms already set, so that you have to pay back 1/10 of the loan each year for 10 years until it's all paid off. Got it? So $200 million, that is $20 million a year. And you can handle the interest. That'd be $14 million interest in year one, but you'd also owe $20 million in principal paydowns. That's $34 million in year one. And, well, frankly, that's where you get nervous. That's a lot of cash out of your pocket here. If things don't go perfectly smoothly and your profit margins of the combined company, Specific Romeo, are less than you'd planned, well, then you could risk putting the company in financial peril, even bankruptcy, because you know that if you don't pay back debt according to the deal's terms, well, then at least in theory, the debt holders could knock on your door one day and take ownership of your company. Yeah, company suicide, career suicide, the financial end of the world as you know it. So you look at paying the $200 million in equity instead of debt, and you're wondering how to assess that cost. Got it? So you have $1 billion, you're going to give a fifth of that, or $200 million, to the shareholders of Alfa Romeo in return for their excellent cars. All right, well, on your own this year, you'll have $300 million in revenues to Specific Motors to deliver $40 million in earnings. You trade at 25 times that $40 million of earnings, $1 billion. Remember, you have 50 million shares outstanding, trading at $20 a share. Do the math on both sides, and you'll get $1 billion either way. See, we do it here for you at no extra charge at Shmup. You can see it right there on the screen. See how we do that? Very nice. All right. Well, your business doesn't have a lot of research and development, not big capital expenditures. So most, if not all, of your earnings is cash earnings. That is, of the $40 million in earnings this year, well, close to 100% of it is cash. We'll just call it that for this problem. All right. Well, if all you were was a dividend-producing machine, well, then this year you would be showing a, quote, free cash flow yield, unquote, of 4%, or $40 million in cash generated by the billion-dollar market cap company that you have going on there. Got it? That's $40 million over the billion-dollar valuation. That's like a 4% cash yield for investors. Meaning if you paid $20 for a share of stock, you got about 80 cents in cash production from it. So that's 80 cents over $20. The combo gets you a 4% cash yield. So yeah, that's how you assess the cost of equity. You're paying for things in all stock with about 4% kind of yield money. So if you're paying a fifth of the company to buy Alfa Romeo, well, you're going to dilute that cash yield down, and then you just have to do the math whether Alfa Romeo generates enough cash to make the difference to you. Does that make sense? Yeah. Okay.